It's been 2 years since World Health Organization declared COVID-19 as a global pandemic, and we are feeling the impact of it now, especially the increase in inflation. How did this happen? Can investing in the stock market help? If you have been following us, you know the answer is yes. Before you press pause or exit, you need to listen to this alarming truth. Hello, I'm Elizabeth, Beyond Insights coach, and today I will share how and why the stock market is able to do that. In the past few years, we have seen global trade wars, pandemic, and now full-on wars between countries. All these events resulted in reduced productivity, loss of lives, business closures, trade disruption, etc. These adverse economic situations have forced global central banks to increase money printing to record levels in order to revive the economy. Let us take a look at the charts here. There is a significant surge of money printing globally in 2020. The European Central Bank, ECB, and United States, represented by the Federal Reserve, have the highest money printing among the rest of the world, as shown from their central bank balance sheets. Now, how will all these money printing affect ordinary people like us? Money supply flushing in the economy has resulted in high inflation occurring in many countries. It increases at a faster pace than the real economy output can cope. Inflation increases the price of goods and services over time, thus decreasing the number of goods and services you and I can buy with a dollar in the future. A dollar today will definitely be worth much less in the future. As a consumer, we should be worried about our decreasing purchasing power. So, how much do we need to earn to compete with this crazy inflation happening now? This scenario has made the rich get richer and the poor get poorer. The rich are equipped with knowledge and skills to appreciate their money much faster than inflation. This is how the wealth gap around the world is happening now. It has become a concern for major countries like the United States and China. Now, what can we do to secure the value of our money? We often hear people saying the stock market has risen over 100%. Some stocks like Tesla, an electric vehicle manufacturer, have even risen over 1,000% from their pre-pandemic level. Is this really achievable? The answer is yes. The question is, do you want to grab a share of this, and how much can you make from the stock market? Let us take a look at the stock chart for Apple. The stock rose 240% from its pandemic low. You might be wondering whether Apple's performance is consistent. Let us compare the year-to-date return for Apple over 5 years with the annual inflation rate of the United States. As you can see from here, apart from 2018's negative return due to the trade war between the US and China, Apple has shown performance way beyond the inflation rate of the US or Malaysia over the past 5 years. I know some of you are thinking, why not save money in the bank for an interest? Let us compare the interest rate of savings accounts in the US. It is around 0.06% versus the current inflation of over 7%. Fixed deposit rates in Malaysia are currently around 2%. Not ideal at all. Let us pause and think about it. Is investing in the stock market a lucrative action to beat inflation? I believe you have the answer in mind. Would every stock give you over 100% returns? The answer is no. Generally, stocks can give a better than average return, while some stocks may have better performance. Let us take a look at Visa's stock chart. At the end of 2021, it recovered 74% from its pandemic low. Remember what I said about Apple earlier? Apple recovered 240% from the same period of time. So what is the realistic return from the US stock market then? Let us use the S&P 500 as a benchmark. The S&P 500 is the index for top 500 large and reputable companies in the United States. It represents the performance of the overall US stock market. The average annual returns over the past 5 years was 17%. And this is what you can expect from the US stock market. Of course, this also depends on your trading style, whether you are investing long-term or trading short-term. The average annual return of 17% is assuming that you are an investor holding a stock for a longer period of time. 17% return per year. Isn't that great? 5 times the return of regular savings or fixed deposits. Let me show you the performance of some great stocks that we have analyzed and selected in our watch list. As you can see from here, you can get a much better return than the S&P 500 index by selecting the right stocks. Of course, these are some of the top performing stocks on our watch list. And the returns also depend on your trading style and skills, whether you choose to invest long term. which we believe that everyone can and should, or do short to mid-term trading, which would yield a higher return. That said, investing is undeniably one of the most rewarding ways to beat inflation and tighten the wealth gap. The example shown earlier with the S&P 500 index with an average return of 17% is a good expectation to set for your investments. So, what insights have you gained? Was it beneficial to you? If you like this video, please hit the like button and share with your friends. Comment below and let us know where you're tuned in from and what other topics you would like us to cover. Finally, if you haven't already, please smash the subscribe button and notification bell to stay tuned with us. I'll see you in the next video.